resources for our minority and women-owned businesses as their counterparts. We are also part of the SBA Navigator program that works with businesses in underrepresented and underserved communities that are often faced with difficulties accessing capital, contracting, marketing, operation businesses, and business development, and exporting to make sure you are aware of the products and services that they have to offer. A little bit about our other partner, the Bridgeport OIC Biz Hub. Bridgeport OIC has been unlocking the doors to opportunities in greater Bridgeport communities for over 20 years. They prepare and empower adults for today's workforce, small minority and women-owned businesses by providing training programs, support services, and entrepreneurial development. Both of our agencies' contact information will be located in the chat. So if you want to get in touch with us or learn a little more about either one of the agencies, I just want to let you know we are having next Thursday at Housatonic Community College from 6 to 8 a workshop on access to capital, and we'll have a great range of different resources there that can provide your businesses with all different types of loans and grants. You can send out an email to myself with the Southern Connecticut Black Chamber, and I can send you information on how to register. And again, I want to thank you so much for joining us today.
Thank you very, very much, Diana, for your opening comments and for the very, very strong support of the agencies that you manage and represent. So thank you. It's now my pleasure to introduce our speaker, Aya Beckles Swanson. Aya is the Executive Director of the Lab at ConnCORP, a minority business incubator in the heart of the New Haven and Hamden area. She has lived and worked in Connecticut for almost 3 decades, honing her expertise in economic and business development, community outreach, and small business lending. Prior to serving as executive director, Aya worked under former New Haven Mayor John DeStefano and for the town of East Hartford in economic development, as well as with the city of Meriden on brownfields projects and transit-oriented development. Aya also spent years at the Community Investment Corporation and Essex Savings Bank, working as a commercial loan officer with a focus on SBA and micro lending. Aya now uses her experience and position to run the lab at ConnCORP and assist in the development of successful Black-owned businesses through guided support, advice, and mentorship. It's now my privilege to turn the microphone over to Aya. Aya, it's all yours.
Thank you so much, Peter. And thank you so much, Diana, for inviting me to speak today. This is a passion for me, talking to business owners about how to successfully grow their business. I didn't mention in my bio that I had a business of my own years ago. I used to do college prep and SAT preparation, and really enjoyed doing that work, seeing how fulfilling it was for myself and for my students and their families. And so now I get to bring a little bit of that knowledge and also my years of experience in economic development and commercial lending to bear at the lab at ConnCORP. And I should just say here that the lab at ConnCORP is a minority business incubator. If you have any interest in finding out more about us, all of my contact information and all the ways to reach us will be at the end of this presentation. And I want to jump right in and say, I've done this presentation in the past, but it's always been in person. It was always pre-COVID, because I think our lives are now measured in pre and post-COVID. And so pre-COVID, I would do this in person and be able to get a sense of what people's questions were, what the energy in the room was like. Did I lose people? Are people, attentive? And because of Zoom and the technology that we now use, I don't get that as much. So instead of leaving all the questions till the end, and having me just talk and hopefully not just read the slides to you because you all can read, I'm going to have an ask that people jump in right in the chat, leave their questions, because I really would like this to be as participative as possible, despite our need for new post-COVID technology. So please do jump in. I do want to answer your questions. I don't just want to talk at you. I want to talk to all of you. And I really thank you for being here. So let me jump in right now with the main question of the day, which is, why is credit important to small businesses? And the reason is that at some point, as a small business owner, you are very likely to have to approach some kind of lender, whether it's a bank, an SBA lender, perhaps a small business administration lender, doing microloans or community advantage loans, the kind of things that I used to do, or your credit union. You're likely to go to some source for a loan. And one of the many things that lenders look at includes character, and that turns to credit. So let's talk a little bit about what those things are that they're going to be looking for, because I want you, when you go before a bank, a lender, whoever you talk to, I want you to know the same things that they know, right? Do your homework, be prepared. You don't want to ever walk into an interview completely unprepared. And asking for a business loan is a little bit like being interviewed. So let's go from here. The first thing that you'll want to do as a business owner, if you haven't done this yet, please do this, is open a business checking account. One of the worst things you can do, and I speak from experience, is commingle your business and your personal. It invariably happens. You start out all gung ho. I've just started another business myself. And you just want to jump right in. And so you figure you'll put all that financial stuff to the side and just start doing what you're good at. And in my case, I started a business where I'm doing meal prep. So of course, I just want to jump in and cook. And so now, despite the fact that I teach this, I need to go back a couple of months. I've already set up my business account. But I do need to go back a couple of months and sort through the income, the expenses. It's so much cleaner to do this as soon as possible. So please take my advice. Don't do what I did, do what I'm telling you, and start out by opening a business checking account. That does a couple of things. One is it keeps your business expenses and your personal expenses separate, keeps things very clean, makes it easy when you go to do your taxes, easy for a bookkeeper if you're working with one or an accountant, easy for you if you're using QuickBooks or Excel. It also establishes a relationship with the bank. So this is your opportunity to go in and talk to a bank officer, talk to a loan officer about what it is you do. Use that elevator pitch that you've been working on. It's so helpful to establish that rapport so that when you do need to come and ask for a loan, they already know you. They know that you come in and make deposits or make withdrawals. They've seen you and they've heard about what it is you do. So this is a great opportunity to just establish that relationship so that the first time that you're coming into the bank isn't when you're asking for a loan, but when they've already got to know you as a business person. And as I said, there are certain things that any lender, no matter who you go to, even if it's friends and family, although that can be nerve-wracking and can make Thanksgiving a little awkward, but no matter who you go to, if you're asking for a loan, everyone's going to want to know a certain thing, a few things. They're going to want to see a business owner who knows the business, knows what he or she is talking about, knows what they are talking about, is willing to work hard. They want to see that go get it attitude. They want to see either a business that's already financially sound, ideally, but if it's brand new, that the business is making enough money to pay its bills and then potentially pay back a loan. almost all lenders, if you are going to a bank, credit union, a micro lender, they're all going to want collateral. And we'll talk about what that is in depth in a few more slides. They're going to see something that mitigates some of their risk in lending. And then everyone is going to want to see an investment from the business owner. So some of your own money that's going in. When I first started out in commercial lending, I had just come out of economic development. I was very much like a cheerleader for small businesses, and I desperately wanted to lend to everybody. I just was like, completely like my heart just went out to business owners, especially as one myself. I get it. It's stressful. It's a lot. And so I wanted to lend to everybody. And I remember going to my chief lending officer at the time and sort of giving this whole spiel, like, why can't we just lend to more people? Why can't we just take a chance on everybody? I wanted to be like Oprah, like you get a loan and you get a loan. And he made a very good point. He said to me, Aya, how can someone expect me to invest in their business if they're not willing to invest in their business themselves? So please know that anyone you go to, even if it's your cousin's friend's uncle, even if it's your loaded great grandpa, whoever you go to is going to want to see you putting some of your own money into the deal. To ask for 100% of funding means that maybe you don't trust that you'll get your money back. And so then they get a little nervous, like, will they get their money back, right? So bear in mind that these are the things that anyone would be looking for. And we're going to get into what's called the 5 C's of credit right now. So the 5 C's of credit are character, capacity or cash flow, collateral, that would be some sort of tangible asset that a lender can hold on to just in case things don't work out and they have to call the loan or they have to liquidate the collateral. Capital or contribution, that's what I was just talking about. Capital is in something that you, the owner, puts in yourself, some funds, some contribution that you are making to the deal. And then condition, the condition of the loan. Again, we'll talk about that in a second. So this first one, character, is where we come to the conversation specifically about credit. Because as much as, and this is with non-traditional lenders, I can tell you, as I was one myself, I was doing micro lending and SBA lending, which is lending with the support of the Small Business Administration. So I can tell you that your character, your personal reputation, the impression you make on your lender, your integrity, those are very important things. There was a time many, many moons ago, probably not in my lifetime, but there was a time we know that people, a person's word was as good as their bond, and a handshake meant you were going to do what you said. And we're still looking for that, but as we all know, the world has changed somewhat. And so we have to look at things besides just your personal reputation. So know that when you go to a lender, yes, they are going to Google you, for example, to look up your personal reputation. They are going to do some basic background searches. So they'll look for any, they'll do a judicial search, for example. And bear in mind that that is not necessarily a bad thing. So you could certainly have had concerns and issues with the courts. It feels like everybody's been in the courts. If you look me up, you'll see that I went through a divorce. So everyone's had some sort of interaction with the judicial system. But please know that it's not going to necessarily make or break your deal. What they're really looking for is, have there been instances in the past where you said that you would pay back a loan but didn't? Have there been instances in the past where you have, said you would do X financially, and then you couldn't for whatever reason. And if the reason is a good one, that's understandable. Certainly, we see more and more, which breaks my heart, a lot of issues for people around healthcare. And so I've had a customer in the past who had a great deal of medical debt because of his wife's health. That's fully understandable. Life happens, and that was not held against him. But people are looking to see what you have done in the past, trying to get a sense of what you might do in the future. So please know it's not going to necessarily affect your loan, but know that that is something that a bank or a lender will be looking at. And it makes sense that you will be upfront about these things. You don't ever want to surprise a lender with information. You want to be upfront and say, look, you're going to find that I had medical debt on my credit, and this is what happened. I was ill, some family member was ill, and it just became overwhelming. And that's fully understandable. In fact, a lot of non-traditional lenders now disregard medical debt because of that very issue. So they'll be looking at how long you've lived in your neighborhood, whether you have an account with the bank. That's why I said establish that right up front. And then how you pay your bills. So this will be information they'll get from the credit bureaus. References, you might ask friends or family to vouch for you, someone that you've done business with, a former boss, someone who can speak to your honesty, your integrity. And most importantly, they're going to look at your management experience you have in running your businesses in the past, how much experience do you have? And if you don't personally have experience in that field, like say you're opening a restaurant, but you don't cook, that's fine. Do you have a chef? Do you have someone who does? And if you don't necessarily do the finances, do you have someone who does that? So do you have a team of people to work with and help you? So let's talk a little bit about this. This is the side that always makes people a little anxious. Please don't be. Know that, as I said, I've been a small business owner myself. I have absolutely been where you are. I went through a divorce in the past, and I will be honest, like a lot of people, I sort of stuck my head in the sand. And I said, I don't even want to know what's going on. I'm sure that my finances are in shambles post my divorce, and I just don't want to think about it. And that did not serve me well. And I assure you, the longer you avoid looking into it, the more scary it gets. And the minute that you cease to avoid it, it becomes less of a boogeyman. So what I had to do, and I recommend you all do, is I had to go on to not freecreditreport.com. I know you've heard the phrase freecreditreport.com because they have very good marketing people, but freecreditreport.com is not free. Annualcreditreport.com, if you write down nothing else in your notes from this entire presentation, please write down annualcreditreport.com. This is the one that is free. This is the one that the federal government required each of the three largest credit reporting agencies, Equifax, TransUnion, and Experian. They require them to provide information to consumers about what details they're keeping about us. And so if you go to annualcreditreport.com, you are able to get a report from each of those three credit reporting bureaus. What I will tell you is this, because I've done it myself. The first thing I'll tell you is you will not get an actual score, which can be a little frustrating, but don't let that stress you out. You can, if you choose to pay for a score, you can go ahead there and pay. Oh, and I see there's a question. Someone has asked, are there ways to get loans without using my personal social security number? Olivia, I'm going to say that you should definitely have an EIN number for your business. So you definitely will need to have that if you're applying for a business loan, and that's like the ID number for your business. However, you will not be able to apply for the loan without your personal social. Every lender, every real lender, I should say, and I'm going to talk very briefly at the end about fraudulent lending, but every lender, bank, credit union, micro lender, SBA lender will ask you to fill out a personal financial statement. They shorten it to PFS, and it will require your personal social security number. So even though you should have a business ID number, your federal EIN, you will have to also provide your personal social. And then the question is, should I open a credit card even if I don't need one in the EIN so that over a number of years I can do a loan without a guarantee? Okay, so, and will I cover best ways to build business credit score specifically for the real estate space? Okay. So I'm going to respond to those questions, and then I'll jump in a little back into the slide that I'm on right now. So should you open a credit card even if you don't need one in the business name, in the business EIN, so that over a number of years you can do a loan without a guarantee? I do recommend, and bear in mind that everyone is different and everyone has different lending and borrowing habits. But I do recommend at a certain point in your business, like right this moment, I just started my business last year. I don't need a business loan, but I'm going to take the training that this bank provides in entrepreneurship, even though I've got a lot of experience in it myself. It never hurts to learn. I'm always open to learning. So I'm going to take their training because at the end of it, this bank offers a $5,000 line of credit. And that line of credit will allow me to establish business credit. That said, Olivia, I want to be really clear because your question was, should I apply for that loan in the business name so that you can get a loan without a guarantee? That does not mean that in the future, just because you've established business credit, does not mean that you won't be asked to provide a guarantee on a loan. So yes, it is a good idea to build business credit over time, provided that you're going to use it responsibly. So please don't take out, if I'm going to get a $5,000 line of credit through my bank once I finish their training, I am not immediately going to go out and max that out, buy something for 5,000 and then not be able to pay it back. That would be establishing poor business credit, and that's not my goal, right? So what I may very well do is buy one piece of equipment that I need. Like I said, I'm doing meal prep, so maybe I buy a larger or more efficient food processor. But hopefully that won't be more than a few $100s, and I can pay it right off or pay it off in a timely fashion so that I'm establishing good business credit. That does not mean that in the future I won't be asked to give a guarantee if I ask for a larger loan. It just means that I'm establishing hopefully good credit in both my personal name and my business name. I hope that helps, Olivia. And then Ray, well, I covered best ways to build a business credit score specifically for real estate space. Yes, I'm going to do that right after I talk about personal credit scores. And then, hi, Dee Dee. You have a for-profit and nonprofit. What agency can help me get clearer wording on what exactly it is that we do? Someone told me that my website doesn't describe accurately what it is that we do, and I'm feeling overwhelmed. Dee Dee, believe me when I tell you, I know what it is as a small business person to feel overwhelmed. And I can recommend SCORE to you. SCORE, who is hosting this webinar along with Southern Connecticut Black Chamber of Commerce. SCORE is a wonderful resource for help with wording on what you do, for help with your elevator pitch, for help for how to, put together a website. So please do take advantage of their help. Peter, can I turn to you? Is that something that SCORE can help with?
Yes, absolutely. That's what we are around. We are all volunteer organization, and we work with folks who want to become business people or are in business and have questions. So at the bottom of this webinar, you can click and look for a mentor, or you can go onto our website at fairfieldcounty.score.org and look for a mentor that can help you. So Dee Dee, that's, as Aya has said, that's exactly what SCORE is available for, is to mentor and coach and work with you to help build your business.
Perfect. Thank you, Peter. And Betty, I see your question. When you have a business, you hire your kids under 18. Which one is better? Put them on the payroll or give them a 1099 at the end of the year? For that one, I have to say, Betty, I'm going to recommend that you speak to an accountant because everyone's business situation is different. And I don't want to give you the wrong information. It really depends on your personal and business financial situation. So accountant is going to be the best person to guide you on that one. I don't want to put you wrong. Okay. All right. So I'm going to jump back into this slide and then don't keep me honest. It was Ray. You were asking about the business credit score. Please keep me honest and remind me that I got to get to that for you. Okay. So personal credit standing. As I mentioned before in answer to Olivia's question, there is no way around the fact that a lender is going to pull your personal credit. You may have situations when you speak to a lender, you may get someone who'll do a soft pull, but there's no world in which they're not going to ask for your personal social. So let's talk a little bit about your personal social, and then we'll talk about establishing business credit. So what I recommend is a couple of things. Because you get this free, as I said, reports from Equifax, TransUnion, and Experian. They're required to give them to you annually, hence the name annualcreditreport.com. What you will find is when you go in and you put in your information, and they will do a lot of background checking, making sure you are who you say you are. Once you get through that, you'll be offered you'll offer you one of each, a report from Equifax, TransUnion, Experian. Some people choose to monitor their credit reports over the course of a year by pulling one of these three every 4 months. So say you just want to monitor what's going on with your personal credit, you can say go in the beginning of the year, pull one of them, wait 4 months, pull the next, wait 4 months, pull the next one. And that allows you to get over the course of a year, really holistic view of what's going on with your credit. Again, as I said, unless you pay to get your credit score, you won't see a score, but you'll see the information. So you'll see who the lender is that you borrowed from, how much, if there were any delinquencies or late payments, if there were any concerns or anything sent to delinquency or to a creditor. You'll see if there were any bankruptcies, all of that. So you're not going to get a number necessarily unless you pay for it, but you will see everything that's being reported. The alternative to doing that, to monitoring them over the course of a year, is if you know you're about to go in and ask for, make a business loan ask or do a big purchase, you might want to pull all three at once. That's what I've done in the past before I've gone to apply for a car loan, for example. I'll pull all three just to make sure I know what's going on. Now, this is the stuff that people, may not be as aware of. So I like to, again, let you in behind the curtain. It's important to me that you know the same thing that your lender knows when they're asking you about your business. I don't want you going in blind to an interview, right? So you should know what they're going to be looking at, what they're asking for. So they're looking at a credit score. And they're looking at these things here. As you can see, your payment history, whether you paid on time or not, is the most important piece of the puzzle. Okay, it's 35%, makes up 35% of your score. The next thing is the amounts owed. So that's why you're often told not to max out your cards, to make sure that you keep them at a certain level so that you're not looking like you owe so much that it's unmanageable. New credit. So if you've requested a bunch of credit cards recently, you'll see that'll have an impact on your credit score, an impact on your credit. And then the length of credit history. This is something I get asked a lot, so I'm going to touch on this. When I myself was, like I said, pulling my head out of the sand, when I ceased to be an ostrich, when I had to accept that I had to take a cold, hard look at my finances and my credit reports and so on, I was really tempted to just close all the cards and get rid of them. And I will say this, length of credit history is determined by the earliest, or the card, the whatever debt you've had the longest. So this is up to you. Again, I'm not an accountant. I don't want to give I want you to bear in mind that everyone's situation is different. But the advice that I give when I'm asked, or what I've done for myself, is I did try to get rid of that slew of credit cards. I didn't want to have 10, 15 cards, but I did keep open the card I'd had the longest, because the length of credit history is based on the earliest ever borrowing that you did. So if you close a card you had when you were 20, for example, then whatever card you got next is going to be considered the length of your credit history. So I keep open, and I don't carry a balance on it, but I keep open the card that I had the longest. That's what I choose to do for myself. I did, because we've all made mistakes. I did have way too many cards at one point. And here's what's interesting. This is something that I learned when I was a commercial lender. The thing about underwriters, the thing about bankers, is not that they don't want to lend. It is that their job requires them to think the absolute worst up scenario, to just imagine the worst. So it's not, so everybody there, I mean, that's a commercial lender's job, right? Is to lend. We want to lend. But it's for the underwriter to say, bump the brakes. What if this terrible thing happens? So I was surprised to find, when I had a customer who had a good score, or a decent credit score, had, I want to say, let's say 10, 15 credit cards. But they were all at zero. And so I thought, this is great. What's the problem? I was young. I was a junior loan officer at the time. And I say to my underwriter, like, why are we, dinging this person for having this many cards? They're all at zero. And the response I got was, yes, they may all be at zero, but once the loan closes, they could potentially go out and run them and max them all out. So please bear in mind that, yes, you might be thinking to yourself, oh, I'm using my credit responsibly. I'm not going over 50% of usage, or I'll have them all at zero. So what's the big deal if I have 30, 40 credit cards? It will still be seen as a danger to a lender if you could potentially max those all out after the loan. So I personally closed many of my cards, except the one I'd had the longest. I closed many of them because I wanted to control that. And I also know myself, and I know if I've got a ton of credit cards in my wallet, one of them is going to get used. So bear that in mind. Bear your own spending habits in mind. The rule of thumb really is that people tend to spend more with credit cards than they do with cash. I've really taken to forcing myself to walk with cash, even though I got used to not doing so, and just got no choice but to stop when that money just goes. And I just try to limit myself that way. But do bear in mind that to a lender, a lot of cards, even if they're at a zero balance, could be a red flag because it means you have the potential to go crazy once your loan closes with them. Okay. I am taking a look at, I'm just looking. I see, is it easier to apply for SBA loans than traditional loans from the bank? From Valentine. Oh, yesterday was your special day, Valentine. Um, is it easier to apply? It depends on how you define easier. I will say this, SBA loans have a lot more paperwork. There's a lot more going on. Sometimes they can even take longer. So that part I will fully admit. When I did SBA lending, I really did a lot of hand-holding of my borrowers to get them through the process because it does feel like it's a lot. That said, so that part isn't easier, the paperwork part. The SBA loan is supposed to be easier in that the lender, the SBA lender, has a guarantee from the SBA. So they're able to be a lot more flexible, basically, in how they look at your loan. They're able to concern themselves more with your character, who they see in front of them, than with just fitting into a credit box. They're able to underwrite loans for startups that some banks won't touch. Some banks won't lend unless you've got 2 years of financials. So depending on the easier part, easier in terms of because the SBA mitigates some of the risk for the lender, it does allow them to do loans that maybe a bank would not be as comfortable with. But I will admit that from the point of view of the paperwork or the process, you will find that you'll need to lean heavily on your SBA lender for support with that. And then the bankruptcy comes off your credit report after 10 years. My recollection is it's 7, but I'll double check that for you. It can stay on your report for up to 10 years, but it should fall off automatically at the 10-year mark. Is an interest-only loan the devil in disguise, Shante? I like that question. Again, not necessarily. That's a good question for an accountant if for your personal finances. I am personally very risk averse. So I've never been a fan personally of taking out an interest-only loan. But there are those who use them effectively. I wouldn't necessarily call it the devil in disguise, but it's definitely something that you want to do your homework on professionally, definitely with a financial advisor or your accountant. It depends on your comfort level and also, just how flush you are, how much you can, the level of risk you are willing to take on. I see that question was answered, that the information presented and the resources discussed are open to all businesses. So no, Glenn, this is not just for Black people in Fairfield County. And then, yes, you will be provided, Dee, with my contact information. I'm going to have a slide on that right at the end. You can take all the information down. Okay. And then, yes, Ray, you agreed with me. Typically 7, but still remains on. At 10, it falls off automatically with the bankruptcy. Okay. So I wanted you to see on this slide just how your FICO score is broken down. And that length of credit history thing, yes, is important. And then, of course, there are other credit factors, if you pay your bills on time, etc. That's the payment history is, of course, the biggest piece of that pie. Okay. So lenders do use the FICO score, but it's only one factor when deciding. There are other things in that 5 C's of credit that they take into account. Now, two things. If your report is, if you've come across, whether you pull all 3 credit bureau reports at once or you spread them out, if you find that there are mistakes, those can be addressed. One big thing that I found a lot, you guys, as a lender, were families where it was, you know, John Smith II, John Smith III, John Smith IV. A lot of it was very typical for the credit bureau to make mistakes on those reports just because of the same name and possibly living in the same town and so on. So that is a concern, and that's definitely something you should review your credit report for, any potential mistakes. If you do find a mistake, you contact the creditor in writing. You can do that via their website. They do accept disputes submitted online, and ask to have the report fixed. The burden of proof, as they say, is on them. So if they can't prove that the information is correct, they are required to remove it. So be sure to contact them in writing. And then if you do it online or however you do it, make sure you save a copy of that, screenshot it, whatever. If you're going to do it physical letter, keep a copy. Show that to your lender to show you are in the process of disputing it. It really looks, it makes it clear to them that you are serious, that you know what is going on, and that you're disputing any errors that are found. Now, if the report is correct but negative, then try to fix that before applying for a loan. So start making your payments on time, start paying as agreed. Reduce the amount of debt you owe if at all possible. Do whatever you can, the odd jobs to pay down on that debt. And that's something that I know Diana was asking me earlier if there are other things that I talk about or other areas I talk about. A big one for me is I love to discuss. Oh, I just saw we have 15 minutes left. But a big one for me is I love to talk about paying down debt and the debt snowball, because that was really effective for me. So reducing the amount of debt you owe is very helpful. And then, of course, working with a nonprofit, working with SCORE, working on with any of the small business supporting orgs that provide free credit counseling, that is going to really make a big difference. So I'm going to, and then somebody asked, do lenders want you to have a DUNS number? It is not a requirement, Nika, but it cannot hurt to establish your business credit by getting a DUNS number. And for anybody who's not familiar, that's Dun & Bradstreet. You can go to their website and apply for a DUNS number. That's another good way to establish business credit. I'm going to pop to the next slide. And I'm going to go through, before I go to the other C's of credit, because I want you to be aware of them, because these are the things that lenders do ask about or want to know about. But since the topic today is why is credit important for businesses, I do want to say establishing business credit is a good idea. So Naika, you don't have to have a DUNS number when you apply for a loan, but in terms of establishing business credit, it is not a bad idea at all. You can also, of course, take out a card or a line of credit in the business name, as I mentioned, but be careful again how you use it. It does you no good. I had a client once who did not have any credit of any kind, and it was very difficult for me to do the loan and to get the loan underwritten because of that. And so without double checking with me, he went out in an effort to improve his application, went out and got a business credit card, but then did not pay it as agreed. Did not, bought something for like $100, but then didn't pay even the minimum payment, far less pay it right off. And so it actually immediately established poor credit, and then I wasn't able to do the deal. So please be very aware that start, I would say, by making sure that you do all you can, if you need to clean up your personal credit, or to at least just pull it and know what's going on with it so that you can speak honestly to the lender about what's going on. But if you're going to establish business credit as well, make sure you do so carefully. A lot of us established personal credit when we were in our teens, or when we, first got free of our parents and we're like, oh, someone's going to give me free money. And we made really poor choices at the beginning. And I speak from experience. And now we are having to mature into doing things differently. Now that we're at this point and we're establishing business credit, don't make the same mistakes twice. If you're going to establish business credit with a DUNS number, with a line of credit from your bank or your lender, with a business credit card in the business EIN, just to make sure you do so in the most sensible fashion possible. So buy something small, pay it right off. Use it for gas, pay it right off. Do something where you're building really positive credit. And then how bad is it for your credit report, if at all, to apply more than once if there's a refusal initially? For every hard pull, there is an impact on your credit report. And by hard pull, I mean that when a lender checks your credit, there are two ways they can do so. They can either do a soft pull, which just, doesn't have a negative impact on the credit, but might not give them all the information they need. Or most lenders, if you're applying for a loan, are going to do a hard pull. It does have an impact on your credit. It I would say, Glenn, it depends on how much time you wait in between those applications. So if there's a refusal initially, I would try to find out what caused the refusal and try to address that. If it was because of your credit score or something on your credit report, address that first before going back. Be wary of the advertisements you see for when banks compete, you win, because what invariably happens is the competing banks, whoever the lenders are, will all pull your credit. And that will have, all of those pulls, multiple pulls, 10 pulls, let's say across 10 lenders all at once. That'll be enough dings to really make you notice that. So the main thing I would say is if you apply and there's an initial refusal, find out what caused it, do what you can to address it before you apply again. And then let me talk a little bit about the other C's, because I see it's 12:51. So let's keep going. Your capacity or your cash flow, that's of course important. So we've looked at credit, whether business or personal. Now the banker or the lender is going to look at your cash flow, your ability to repay the loan. They're also going to look at if you're existing business, your historic cash flow, so how you've done in the past. If you're just starting, they're going to look at your business plan and your projections. So make sure that your projections are solid, that they make sense. What you don't want to do is projections where you just say, I'm going to make $1 million in my first year, and then you divide it all up over 12 months. That's not really realistic, right? Most lenders know you're not likely to even be in the black in your first year, far less make $1 million right out of the gate. And if they just look at it where all you've done is divide those, that money up over 12 months with no seasonality, with no changes, no fluctuations, you'll want to really look at those more carefully. So please work with somebody at SCORE, work with one of the many organizations that can help you with your projections. And that's something that I do a lot of. I help businesses with projections at the lab at ConnCORP. Collateral, we talked about a tangible asset that you're more than likely going to be asked to pledge. And I know I was asked that earlier. Is there a possibility that if you establish business credit, you wouldn't have to provide a guarantee? That is very unlikely. So you are going to be asked to provide something of value, a personal guarantee, a tangible asset to repay the loan, even if the business fails. And then capital or contribution. Remember that skin in the game that I talked about earlier, that, asking for 100% of the money you need tells a lender, even if it's a family member, you don't believe enough to put your money up. Why should I? So you're going to have some skin in the game, your equity injection. Condition is something that that's one of the C's that people aren't as familiar with. Condition has to do with the loan amount, the interest rate, what you're using the loan for, and then how well people are doing in your community and how well your business's industry is doing. So let's say somebody came to me and asked to borrow $1 million, and they wanted to start, they wanted all working capital, no fixed assets. So they're not buying anything tangible. $1 million in working capital to start a newspaper. Not super likely, right? So there are a bunch of things going on with the condition of that loan. One, it's a really large dollar amount. Two, you're not buying any fixed asset like real estate or equipment. So there's nothing tangible for me to take back if the business fails. And then three, newspapers are really having a hard time right now monetizing their content. Their paywalls, they're doing a million things, but we all know like it's just a tough industry right now. So that's condition. We're going to be looking at how likely is this loan amount, what you're using it for, and what your industry is. How likely are those things to go together and make for a loan that can be paid back? Okay. And then I'm wrapping up. I'm so close, 12:55. And then I'm going to jump into questions. So being well prepared is a really big key to asking for a loan. It is having a written plan, a business plan if you're just starting out, or even if you aren't just starting out, just a pitch deck to let businesses know like this is what you're going to be doing with that loan and with the loan funds, and telling your story well. I'm big on having that elevator pitch down cold, being able to, just meet someone at a networking event and be able to say right off the bat what it is I do and how I articulate it makes a big difference. I think it was Dee Dee that asked that question, and that's something you definitely want to get down cold. And then being very honest in your presentation of yourself. Lenders don't just want to hear the good stuff. Please be upfront about any concerns you have, anything on your credit report that you're like, look, this happened, life happened, or I made these mistakes when I was younger with credit, but I'm turning it around, or anything that you feel you need to share. Really be upfront. There's nothing that scares lenders more than people being untruthful up front or trying to hide information up front. And the other thing that really freaks lenders out after you get the loan is going radio silent. I would much rather a borrower call me every week and say, hey, this thing happened, or oh my goodness, we just had a flood, or I'd rather you stay in contact and let me know things aren't going well and I might be able to modify the loan or do something, forbearance, something to help and support you, like I did during COVID with many of my clients. Then you just go completely silent and I can't reach you. That's super scary to a lender. So radio silence is the worst thing you can do. And then your business plan, I'm not even going to get into details of that because SCORE can help you with that, but it's important. It's a really important document, especially if you're just starting out. You have to have one if you're applying for a loan and you haven't been in business, for 2 or 3 years or more. SBA's resource partners, you see all of those right here. These are the kind of things that the financial information that a lender is going to want to see: a balance sheet, filed tax returns, your income statement, your projections and assumptions. And then just be careful, please. One final caution of unfair lending practices. So please be careful of any loan offer that you receive that you did not apply for. A lender promises you loan approval no matter what, being rushed to sign papers, high interest rates and fees. Just operate on the assumption that anything that sounds too good to be true is. I literally have seen somebody get involved in a very rough loan where in order for us to even read the fine print, we had to get a magnifying glass. That's a bad sign. And do not sign any documents that contain blank spaces. And this is me. Let me go see the messages really quickly. Okay. So, does a hard pull affect your personal credit? Yes. The question is, how long does it take for your score to go up? I have seen, and again, I'm going to maybe talk to Diana about offering this as the paying off debt as one of the things I can talk about. But for me personally, I very aggressively worked after I'd gone through difficult relationship and financial times. I worked very diligently for a year to pay down debt, and I went from a credit score in the fives to a credit score in the sevens in the course of about a year and a half. So it is not impossible. It is very doable, but it does take a lot of effort, and it does take, I shouldn't say a lot of effort. It takes a lot of diligence. It takes a lot of being very focused and making sure that you get to that place. Will the slides be sent at the end? Gold mine. Thank you, Olivia. I would be happy to share the slides. So I'm hoping that SCORE has all your contact information to do that. And I would love it if, please contact me directly. Yes. Okay, so take all my contact information down because I would be happy to share my slides with you. And please, that number right there that you see, the phone number, is my personal mobile. I'm just that kind of person. Please don't call me at 3 a.m., but you can call me. I am actually a night owl, so you'll probably get me up to midnight. But please do call me and reach out to me. It means so, so much to me. I cannot tell you how much it means to me to help people, like to know that I'm getting up every day and the difference I'm making is a tangible one for business owners, for people who look like me, for people who have been through the things I've been through, even if they don't look like me. It really means the world. So do not hesitate to email me, call me, text me. I'm here for you.
Thank you very, very much. This was a dynamic, and I think Olivia said it well. This is an absolute gold mine of information.
Thank you.
Thank you so much for handling the questions as we went through. You gave a lot of information through the Q&A. So thank you everyone for joining today. SCORE resources are available to everyone on the call. Reach out, get a SCORE mentor, look at the SCORE resources, reach out to Aya. There is a tremendous network of resources and people who want to help entrepreneurs get started. It's all free of charge. So why not reach out and let us help you build your business. With that, we'll bring the call to an end. The recording will be available on the SCORE website within the next day. And I wish all of you a marvelous afternoon. And Aya, thank you very, very much again.
Absolutely, my pleasure. Thank you so much, Peter. Thank you so much, Diana. I hope to do it again soon.
Thank you so much, and thank everybody for attending.
Thank you. Bye-bye.
Bye.